Good evening, all. Ira Epstein with your financial market wrap-up, and this wrap-up is for Wednesday, the 17th of January, 2024. I really wrote a lot tonight in my full research reports, and there's really a lot to say. But before I get too far, I want to remind you that our snap sale, let's call it that, ends tomorrow, Thursday, the 18th of January. What I did is so often I said, sit back, have a cup of coffee and watch me in my morning videos. And what I do, or in the evening, have a cup of coffee and watch these. Well, I decided to look at the price of coffee in Chicago, in my zip code. And for Starbucks on the 11th of January, it was $4.08 with tax, $4.13 at Pete's. Dunkin' Donuts was $3.56. And I said, well, I'm always going to leave a tip. The kids work hard. So you leave that, you're going to be somewhere around, $4.50 on some, maybe a little bit more, to $4 roughly. So I said, you know something? I'm going to price and do what I talk about. So for the past 3 days, and past 2 days, a lot of you've taken advantage of this. I said, you can get my morning future subscriber video for 30 days from the day you sign up, $3.98, no tip included. For the Spider, $4.48, no tip included. When you go in and you register, if you go to the member login, you can let it run, you can cancel it, you can add to it, you can do everything you want there. All right? The point is, I think if you give it a try at this type of price, you might go, wait a minute, he's presenting some ideas I really like in the market. I like that he's showing how the charts come together for it. He talks the fundamentals, he talks the charts, daily charts, weekly charts, 15-minute videos on average, and there's a marker in each video so you see the different sections that I'm in. You can go right to those if you want. Each subscription also includes the ability for you to write me directly, ask a question. I often create a 30 to 1 minute video in length. I'll open the chart up that you're asking about and send it back to you. I devote only so much time each day to that, not a lot, but I do that for my clients. And if you know anyone that is subscribed with me, I think you'll find out I offer an awful lot for this. So give it a try. Move your cursor to the top up here. You'll see an icon. You can go to iraepstein.com under the word research. Choose any of these. It'll be automatic. You don't need a discount code. It'll get you all set up. You'll get a welcome email, and then the very next day at the latest, you'll get access to the QT application so you can get your phone going like we do. I think you'll love what we do there. All right. So let's go to the markets and take a look at what we've got. First, on the energies, more attacks by the Houthis. They're not going to stop. You do understand that. They'll hit, and unless you give an exaggerated hit back, which we are not doing as the coalition, you heard what I said, not doing, and we should, that is the only way this is going to end. All right? You can hit them, hit them, hit them. They're used to war. This is not a people that aren't used to it. The Houthis are absolutely used to the war, and you've got to hit them hard and often in order to stop it. Yes, be the aggressor if that's what it takes. You got to leave this idea of just defense because they'll keep the lane shut down. In the bonds and notes, we've seen recently that we're coming back up a little bit, and that's because all the economic data that's coming in from December looks better than the market thought. Retail sales, prime example. I told you when we saw the November numbers of consumer debt that the consumer went up 3 times the estimate. I said, what do you think that is? It's going to be Christmas sales. I don't want to be short the retailers. I think that you'll get, if anything, if they're going to surprise, it's probably to the upside that they did better. Do I know this? I don't know. They haven't reported yet. We're going to see where they all do. We're just getting indices right now. I want to see the individuals come out. If we're watching what's going on in Davos, Switzerland, I watch it all day long, the different interviews, as to what the big CEOs think, what central bankers think. Central bankers to a central bank that I'm watching think the market got ahead of itself in its thinking that the banks were just going to go, oh, we've got inflation beat and we'll start driving rates down. No, you haven't done that. You've still got strong economic data coming in, not as weak as they'd like to see. The reason you lower interest rates is you start seeing a trend where the data is starting to really falter off and you're scared the economy will go bad. I don't see the bankers scared of that right now. Could I be wrong? Very. I'm Mr. Swiss cheese. I'm wrong a lot of times. You can't have an ego about it. On the other hand, I'm not seeing what everybody sees. I see strong labor. I see everything strong but manufacturing. And manufacturing, the industrial spider, when it went up in December, I kept saying every day, fundamentally, this doesn't make sense. Chart-wise, yes. And I'm a chartist, so that's what I watch. I said, but fundamentally, no. And now you're seeing it one after the other. We're just not at that point yet. Service industry still very strong. And until that weakens, and we see a lot of weakening, I think the Fed has no reason to really jump the gun. Why? Then they've undone all this year in a plus time, all of them, of raising rates to slow down inflation from COVID, and they're going to turn it right back on. I don't think you're right in any manner if that's the camp you're in. And what happened is these stock indices got ahead of themselves. I'm giving you my scenario on it. So as I look at it, does this mean you have to crash in stock indices? Absolutely not, because what's the next game in town? The next game in town is certainly the cutting of interest rates. The question is when, all right? Now, if for some reason we saw numbers really pick up in strength, that would get traders scratching their head, including the Fed. But I think it would take more than a month of that. It would take a little bit of a trend where they see a couple of reports and they go, whoa, we got to go back to raising rates. That's why they won't cut them early. Chairman Powell is not going to make the Volcker mistake. If you think that's the case, boy, are you wrong. He won't cut too early. He'd rather be a bit late to the party. Pretty flat right here on the weekly S&P 500. When you come to the daily, you don't think this is just distribution going on? You haven't gone anywhere since Christmas. You've gone basically sideways and caught in this trading range right now. And if you're trying to make something out of nothing, you get into trouble. The pattern is one of a higher high and a lower low. There is no trend right now. The market is sitting here near the 18-day average of closes. I call that the line in the sand. From the 18-day average of closes, trends develop. Often it requires some sideways action against it, and we're getting a bit of that. You look at Bollinger Bands, the two black dashed lines, because 95% of the time the market will trade within them. But the narrower they get, hence, we're getting narrow, the longer they spin, and eventually you break out of that narrowness one way or the other. If I had a bet today, I'm betting on the bear side. I think the market got ahead of itself. And I think some of this can correct from this late October number all the way up here. And you're trying to just say, okay, so we've taken the market from basically a 48.38 and we've given you a 100-point correction in the S&P, and that's enough. Really? Really? The market was down here under 4,200 to 48, and you've given back one of the 600 points, 100 of them, and that's enough. I have my doubts. Momentum pointing down. I wouldn't be surprised if we challenge down here. I don't see a trend at this point in time. In the NASDAQ, it's very much the same story. You're at the 18-day average. Again, you went from the end of October here at the 14,000, let's call it 500 level. You got up to 17,000, and you've corrected from 17,300 points, and that's enough of that correction for traders to get comfortable and go, we're ready to go up again. I'm not in that camp. I think more of a correction can happen here. Could it be as much as 10, 20, 30% of that whole rally? Typical corrections go that. I didn't say for the year. I said the rally from late October up here. Why not? Does it have to? No. Is there a trend for me to say I'm bullish or bearish tonight? Absolutely not. What about in the Dow? It's the same thing. Higher high, lower low, sideways action, trying to push out the Bollinger Band, but because 95% of the time you stay within the algorithm, it keeps hanging there. Should it let go, there could be more downside here. And again, a market, I can't even show it was down so low. It's got all this, and you corrected what? A percentage point or two? Who cares? You haven't done enough. The market that is still bearish, you heard me, out now bearish, is the Russell. The one that I watch these analysts come on TV and all they do is say, this is it. You got to own these small caps. The market's going. First off, in a bull market, you buy the strength, not the weakness. This is the laggard that gets carried along. And because of that, it's the first one to lose everything. You haven't turned the corner. You know when I probably want to own it? When the Fed does start cutting interest rates. As soon as we get the real belief with fact that it's coming, not analyst opinions. 6 rate cuts starting in March. Nobody's explaining to me why. I can argue with you labor's strong. I can argue with you the economy's still strong. Yes, manufacturing weak, service sector super strong, sales strong, consumer spending. Why is this going down? And by the way, if you want a job, you still got the JOLTS report proving you have 8 million jobs plus that need to be filled. It's not like you can go without work if you want it. In the 10-year note, well, we had the same rally. You went up from the end of October through here. Is this enough of a correction? I don't think so, but I can't say yes or no. I can tell you you're not trending anymore. The market peaked out right at the Christmas time. You've pulled back just like in the stock indices, and we're sort of sitting here void of a trend. I can say the same identical thing in the 5-year note. You've got the tightness right through here. That tightness could set up to be bearish yet and surprise you that interest rates go higher. And in the dollar, it's looking at interest rates going up. It's looking at the landscape and going, they've all built in the demise of the dollar because interest rates are going to start going down very aggressively through the end of the year. And the fundamentals aren't showing it. So the dollar snaps back. And the dollar's the flip-flop of all this. At the end of October, the dollar, in fact, about mid-October, the beginning, it made its high, and it dropped into the Christmas time frame, and it's gotten its bounce. It's the flip-flop of all that. It's not hard to understand. We then come to the euro. 40% of the dollar's made of the euro, and the euro's bearish right now. Now, Miss Lagarde yesterday came out and said it. She doubts seriously that they're going to do anything on interest rates till the summertime. And why would you doubt her? She's looking at the same fundamentals you are and I am. And she's probably coming to the same conclusion. Yes, we know Europe is weaker as an economy than the U.S. And if it's weaker and she's not ready to cut interest rates, why would the Fed be ready? That's one of the points that I have. In the British pound, just when they think they have reason that the Bank of England might be ready to go, they get some economic data like today, and I wrote about it in my full research, that kicks the market back. You are caught in sideways action. You need proof as to what the next move is going to be. This is not proof. This is spinning your wheels, and it's been doing it all of December. Not a place to be. It's really gone between the higher Bollinger Band and the lower band and gone nowhere in the process and hung at the 18-day average of closes. Bitcoin, up here against these numbers, I told my clientele to come out of longs. Now what we're seeing is a massive amount of money's come out of the grayscale ETF, and there's a reason. People were tied up in there. It acted as a trust for an investment from 2013. The first time they got a chance to take their money out just happened. So in waves, they've taken their money out and they've moved it to other ETFs and the like, or they've taken some of the money home, I hope, and they find good use for it in other areas than Bitcoin. But that's what's going on. The second phase is you'll get the likes of Kathy Woods that has owned in her fund a certain amount of Bitcoin and other ETFs. Well, she's got her own ETF. She's going to get out of those and bring it in. So the real question for all this is how much new money's coming in at these prices, not how much old money's moving from point A to point B within them. Remember what I just said. You got to pay attention to that. We then take a look at the energies, and suddenly, and I use the word suddenly, you've lost about 50 cents in these spreads, the difference between the Brent and WTI. Is anything safer in the Red Sea? I don't think so, but that's interesting that happened. You're caught in no man's land in the Brent. Look at the sideways action, and you're just hanging at the 18-day average. If you had to put a gun to my head, I'm in the bull camp on it as long as you stay over the 18-day average. But I don't know that there's anything to really be done here. I saw today, and I write in my evening report, the difference between OPEC's projections for the rest of the year into 2025 in the IEA, and they are vastly different. You want to take a look at that if you get my full research. WTI, same thing. You're just stuck in the sideways action. Heating oil. Okay, people are asking me. I had people talk to me. Ira, what happened there? And I go, do you ever hear of the weather warming up? This was the well-announced winter storm that was going to be the Arctic freeze. Now they're saying you're going to be 10 days from now, a week from tomorrow in Chicago will be 42. We were just 15, 20 below zero in the suburbs without wind chills. So that's the radical shift. The closer we get to February, you still have these shifts. By March, you're pretty much sure you can get snow events, but it's rare that you get big freezing events, and you start thinking, when are they going to convert over from heating oil to gasoline? You got to always think ahead in futures. But is there a trend play? I don't see one right here. I think you're caught between the 200-day average resistance. You scooted through it, got back to the Bollinger Band, and the market punished everybody for that, instantly hurt the traders with it. And in nat gas, you're down to the support area now. Yes, support. The market had been in an uptrend. It lost that. It ran the Bollinger Band, and then when it broke down and lost right here, momentum to the upside, now you're neutral again. I'm in the bear camp longer term, but not short term on that chart. By the way, you hear me talking about here my research. If you go to our website to buy this, and you can do that by clicking up here at any point. You'll see an icon, or you can go to Ira Epstein. You can also scoot on over to our free offerings. Take advantage of my free offer to my research if you haven't tried it before. I think you'll like that. This you won't be getting, all right? Give that a try right now. You're not going to get that price again. So this is pretty cheap. Enjoy the coffee. I'm Ira Epstein. I'll catch you in the morning.